We start with a check on the gold prices, which are currently trading close to 3.5-week highs. The Eurozone concerns have spurred buying in the safe haven metal as Cyprus scrambles to avoid a financial meltdown. Also, investors are keeping an eye out for the Japanese monetary policy next month, where the new Bank of Japan governor is expected to take up aggressive tools to kickstart the world's third largest economy. On your screen, 1600 is still holding. We have seen the gold come off the day's high, though. Remember, the Asian market started with nearly $1616 per ounce early today. Meanwhile, the Brent crude prices have hit a 2013 low, trading around that $107 per barrel mark. Cyprus, Eurozone concerns weigh on the prices as a financial meltdown in the island nation could disrupt the euro recovery, impacting the crude demand. On your screens, a bit of a turnaround coming in, especially for the NYMEX, which is holding around $93 per barrel there. Keeping it with the energy space then, Vandana Hari, Asia Editorial Director at Platts, now joins us live on the show. Vandana, hi, welcome. The US will maintain its current aggressive easy money policy, but on the other side, there are concerns on the elevated unemployment numbers as well. How do you read the Fed statement and the impact thereon in the crude prices?
I think the economic signals from the US, as well as news and some speculation as well on quantitative easing and generally what Fed policies are going to be, has been a major driving factor behind oil prices since the start of this year, well, for some months now, and continues to be until as recently as this week, when we saw the Fed came out to say that they will continue very much the quantitative easing, the bond buying program, the government pumping nearly $85 billion every single month into the US economy. That is definitely a supporting factor for the oil markets. Now, you might ask why, given that, the oil growth, demand growth is not happening in the US. It's happening in Asia, to a certain extent in the Middle East and parts of Africa. The fact remains that it's still the world's biggest economy. US is still the world's biggest oil consumer. So while the oil demand growth in the US is still flatlining, and to some extent that relates to the point you mentioned about the joblessness still being relatively high in the country, the fact still remains that it is the biggest consumer, and whatever is happening or will happen to the US economy will have a direct bearing on the economies of the developing countries where we still see oil demand growth. So the market is paying very close attention indeed to signals from the US right now. As things stand, following this week's announcement by Fed, they'll maintain ultra low interest rates between 0 and 0.25% for the next couple of years, and continue the quantitative easing. 3, as we know it, is broadly supportive of the market and oil prices.
Fair point, Vandana, but where do you see the crude prices headed in the medium to long term now?
Yeah, for quite a while now, 18 to 24 months, we have seen relatively stable oil prices. The high degree of volatility that we saw, let's say the last time that was during the Arab Spring, seems to be behind us for now. The analysts that we speak for are calling for Brent to be around 110 broadly, WTI and NYMEX crude to be around $90 a barrel this year. I would personally, I would think that we are in for a period of relative stability. Again, as a relative is the watchword here as far as oil prices are concerned.
All right, Vandana, and the final question, what's your reading on the narrowing discount between the NYMEX and the Brent crude prices?
Now, what's happening is Brent is by and large still reflecting global crude market fundamentals, and it has been pressured down by a lot of weak macroeconomic data from the Eurozone, certainly, also some fears about Chinese growth sustaining through this year. Those have pressured Brent down. WTI ought to have been pressured down as well, but it's quite largely disconnected from the world oil market. U.S. production is still growing at a very fast clip. But what has changed, however, in the U.S. is that a lot of infrastructure, pipelines certainly, but even railroads to carry the the new growing crude oil supplies seems to be coming into place. So the huge incremental shale oil is actually finding its way to markets in the east of the US as well as in the Gulf Coast where the refining centers are. So that has lent support to NYMEX crude, and we see a lot of buying happening on NYMEX contracts, NYMEX WTI contracts.
Point taken, Vandana. Thank you so much for joining us. So relative stability is what Platts is talking about when it comes to the energy space there. But let's also get in our experts, and joining us now is Shrikant Jha, Managing Director, PJ Commodity Ventures. Also joining us in studios is Vijay Bhamwani, author and CEO, BSPLindia.com. Vijay, you've heard what Vandana had to say on the energy space. What's your own sense now coming in for the crude prices?
Manisha, I've been fairly cautious on crude since the last 2 months, and I would maintain my view. I would actually concur with the guest here that crude prices are likely to remain relatively stable, and I would add the word subdued to it. I think 5,200 is the uppermost limit for MCX WTI crude prices, give or take 25 rupees maybe. And on the downside, I would basically want to watch 49.75 odd levels for signs of support. If at all this support does not hold and it's violated a little forcefully, I think lower levels also might be seen, which could basically be 100-150 rupees lower from there. So the range, in my opinion, at this point in time is 49.75 on the downside. If violated, maybe 4800, 4850. And on the upside, a maximum exuberant level of 52.25.
All right, so that's the view coming in from on case of energy as well. But Shrikant, let's talk about the precious metal space. And in most of last perhaps 4 months, you've seen a very good week coming in for the gold prices. It seems to be headed on a positive closing for this week in case of gold. Not so much for silver though, but what's your sense for both of these precious metals now?
I think it's holding the 1600 at this juncture, but even then I think I'd like to see it go up a little bit more, maybe like 30,100 on MCX. If it crosses that, then I would probably buy into gold. At this point, it's a little, okay, it has taken the support around the 29,500 levels on MCX. It did come down below 1600, now it's come back to the 1600 levels, thereby indicating that it may have bottomed out or it may be consolidating at this stage. But again, let it cross 1600, let it go up a little bit more and give us some indication that it has broken the top and it's going to consolidate after that. Until then, I think there is a possibility of it slipping back again a little bit. So let's wait and watch, and let's look at 30,100 on MCX and see if it crosses that, or maybe 1620, 1640 on the international prices, and then we can take a look at it on the long side.
Shrikant, also what's your sense coming in for silver now? Because not too much of gains onto that space, but do you think it's a sell call coming in for that too?
Yeah, it's actually in a state where I think it may break down a little bit, and maybe you might even see 52,000 is what I think may happen. Then again, I would like to see that other number of about 55,000 or 56,000 on the upside for it to break, to say that what we were seeing now is actually just a false alarm on the downside and it could actually gain momentum and go up. But if I were to trade it on a daily basis, I would probably be short on silver. I don't think I'd be buying into it now.
Vijay, let's talk about the base metal space, and in many weeks we have seen some turnaround coming in for copper as well. It seems to be a positive week coming in for that one as well. What's your sense now going forward?
Manisha, at this point in time, I would still categorize the upthrust in copper as a technical pullback rally alone. Although I have a few long positions here, I would be happy to book profits at 419, 420 odd levels. I think especially the fact that we are staring at a weekend in the face, and the upsides are likely to be calibrated by overhead supply coming in from bulls who've initiated longs at higher levels. As and when they find their break-even point or losses which are reduced to more palatable levels, I would expect them to head for the exit door. So the upthrust is basically likely to be fairly limited in the coming 1 or 2 trading sessions. Give me prices above 424, 425 levels with forceful rise in volumes and open interest, and I might just be tempted to go long again. But considering the weekend factor, 419, 420 is where I would like to exit.